two methods used in accounting for uncollectible receivables are the direct write-off method and the allowance method. When a company uses the direct write-off method, they debit bad debt expense and credit the specific receivable account for the actual loss. Under the direct write-off method, no attempt is made to match bad debts expense to sales revenues in the same accounting period. This is why it's not acceptable in regards to GAAP. The allowance method is the preferred GAAP method because it involves estimating uncollectible accounts for each period. So there are basically two types of acceptable methods for the allowance method that include the percentage of sales and percentage of receivables. Here we're basically estimating who is basically going to do us wrong by not paying us. We debit bad debt expense like we did in the direct write-off method, but we credit allowance for doubtful accounts instead of an actual receivable account because we're working with an estimate, not a specific loss. So let's go ahead to exercise 9-3. The ledger of Hicks & Company at the end of the current year shows accounts receivable 120,000, sales 840,000, and sales returns and allowances 30,000. So for number A, if Hickson uses the direct write-off method, again, this is the one that's not acceptable by GAAP, to account for uncollectible accounts, journalize the adjusting entries at December 31st, assuming that FEL's 1,400 balance is uncollectible. So basically what we're going to do here is we're going to debit bad debt expense for 1,400 and credit accounts receivable FEL. So we're basically crediting the actual receivable. And again, this is not an estimate, this is an actual loss. B and C, you're basically going to have four journal entries. They're all going to be debited to bad debt expense and credited to allowance for doubtful accounts. So keep that in mind. So if we go to B, allowance for doubtful accounts has a credit balance of 2,100 in the trial balance, journalized as of December 31st, assuming bad debts are expected to be 1% of net sales, and 10% of accounts receivable. So for 1, we're going to debit bad debt expense for 8,100. And the way we get that is we're going to take sales, 840,000, minus returns and allowances of 30,000. And we're going to times that, which is 810,000 times 1%. So again, we're going to do debit bad debts expense for 8,100 and credit allowance for doubtful accounts for 8,100. Number 2, for 10% of accounts receivable, we're going to debit bad debt expense and credit allowance for doubtful accounts. And those numbers are going to be 9,900. And how we get 9,900 is we're going to take the accounts receivable of 120,000 times 10%, which is going to give us what? 12,000. Then we're going to take 12,000 minus 2,100, and we're going to subtract the credit balance. Again, that gives us 9,900. For C, assume doubtful accounts has a $200 debit balance, and adjusting entry at December 31st, assuming bad debts are to be 0.75% of net sales and 6% of accounts receivable. So in C, we're actually going to have a debit balance, as in B, we had a credit balance. So basically, what we have, we're going to actually add the credit balance. So bad debt expense is going to be 7,400. Allowance for doubtful accounts is going to be 7,400. And the way we get 7,400 is 120,000 times 6% plus the credit balance of 200. And that's going to give us 7,400. So let me know if that doesn't make sense, and feel free to post any questions into the discussion threads. So 9-3, this is your actual homework. So feel free to use that as a guide, and let me know if you have any more questions.